Cassie and I will be going over the free cash flow and firm valuation for Apple. At the top of the sheet, we have the calculation for the weighted average cost of capital. For this, most of our figures come from the financial statement tab. We used a beta from Yahoo Finance. We continue with the same risk-free rate and market rate assumptions. For the cost of equity, we take the risk-free rate plus the beta multiplied by the market rate minus the risk-free rate. The cost of debt comes from cell E10 on the financial statement tab. Rebecca explained that it is an estimate of the interest rate, which is the current interest rate expense, divided by the long-term debt plus the short-term debt average. Next, we calculate the equity value, which is the current share price from Yahoo Finance multiplied by the number of shares. To get the debt value, we add the short-term and long-term debt for 2019. Next, we sum the two values together. To get the weight of equity, we divide the equity value by the total. To get the weight of debt, we take 1 minus the weight of equity. Lastly, we calculate the WACC. This is the discount rate we use to value the business. The previously stated WACC of 11.96 was calculated before we finished building our final spreadsheet. You can see here that our final calculation yielded a WACC of 11.85. Next, we use our historical data with our forecasted data to determine the free cash flow. To determine the free cash flow, you take the operating cash flow minus the change in net working capital minus the capital investment. The first calculation is to determine the operating cash flow. We have the operating cash flow, or earnings before interest and tax, from row 9 on the forecast tab. The depreciation from row 16 on the forecast tab, and the taxes from row 13 on the forecast tab. To calculate the operating cash flow, we take the EBIT plus the depreciation minus the taxes. Then we calculated the net change in working capital. We calculate the change in current assets for each year using the current year's current assets minus the previous year's current assets on row 32 of the forecast tab. Then we calculate the change in current liabilities for each year using the current year's current liabilities plus the previous year's current liabilities on row 46 of the forecast tab. Take the change in current assets minus the change in current liabilities to get the change in working capital. Next, we calculate the capital spending, or the capital investment. We calculate the change in fixed asset by taking the current year property, plant, and equipment minus the previous year from row 35 on the forecast tab. We add that with the depreciation from row 16 to get the capital investment. Next, we calculate the free cash flow. Next, we calculated an estimated terminal value for year 10. The terminal value is the present value at the horizon of all subsequent cash flows, determined by taking the last cash flow multiplied by 1 plus the growth rate divided by the WACC minus the growth rate. For the growth rate, we use the historical growth rate from the forecast tab over the last 3 years. Next, we calculate the present value of the free cash flow for the forecasted 10 years. Each year discounted by the WACC. On year 10, we combine the free cash flow with the terminal value discounted by the WACC for 10 years. This gets us to a firm value, which is the sum of all of the present values. We get the debt value by adding the long-term and short-term liabilities. The equity value is the firm value minus the debt value. The outstanding shares come from the forecast tab. We determine that the value per share by taking the equity value divided by the outstanding shares. Based on our analysis of the free cash flow, we determine the value per share is $214.24. Compared to the current price of $282.80, we did come out slightly lower. This could be due to the current stock price being overvalued. Since our calculations are based on assumptions, we may have also underestimated slightly with our forecast. Next, Irene will be going over some scenarios that could change our value per share. Thank you.